Good afternoon and welcome to BizTech's Midday Market Watch. Our guest today is Stephen Innes, Chief Global Market Strategist at AxiCorp. But before we speak to you, Steve, let's take a quick look at how markets in the region are now performing. Now, if we look at the regional bourses now, it is mixed. It's not a sea of green. The Nikkei is up 1.08% at 25,108.21. Shanghai Composite is up 3,374.41. It's up 0.02%. The Hang Seng is trading at 26,240.83. It's up 0.86%. ASX 200 is up 0.86% as well, trading at 6,352.8. The only one that is in the red is the Kospi, which is at down 0.14% at 22,443. Now, Steve, great to have you on the show. Markets have been euphoric around the world after Pfizer reported their COVID vaccines phase 3 trial showed no safety concerns and was about 90% effective in preventing infection. Both the Dow Jones Industrials and the S&P 500 have surged to record highs. European markets overnight were also up sharply. But Asia, yes, it's up, but not as sharply, of course, as they were in Europe and in the US. Now, Steve, the big question is there irrational exuberance in the markets, especially given the scientific facts and the operational facts that, one, there will be only 25 million people that can utilize this Pfizer vaccine in 2020 because of the constraints in production. And also, two, there's going to be significant challenges in ramping up production and the distribution of vaccines around the world. What are your thoughts on this, Steve?
Well, I think we're seeing that play out right now in the pullback in the markets. So they're trying to digest how quickly the vaccines can get rolled out. But I think looking at it broadly, I think this is a great win. I think the market was really only pricing in an efficiency of around 60 to even mostly 70% of the vaccine getting delivered. And this is extremely positive. But we also have to remember it's not one or two vaccines in the loop, there's 12. So if we can get market upgrades on a number of these other vaccines in the loop, this will be extremely favorable. But of course, the supply chain and distributions of getting these vaccines to everybody is the biggest concern. However, I think it's overall a great move for healthcare concerns, and I think it's going to, over time, it's going to work quite favorably in the market's favor. Of course, there's a little bit of a massive short covering rally that we saw last night on some of the overextended shorts that were in the reopening narrative because COVID has been ravaging the world again. So a lot of those stocks really benefited last night, whereas the tech sectors continue to sell. And that's just simply a function of higher yields, which are getting driven by this reflationary impulse from the vaccine, which has basically replaced the blue wave impulse. When you think about it, that's what's really happened. So the markets are not completely bent out of shape. This is sort of being expected, and I think we're falling back into the default narrative right now, which is stocks will continue to trade well, provided that central banks continue to provide the grease that lubes all machinery in the markets, the market spectrum.
And also, I think bringing everybody down to reality. In the last hour, there's been a report on Bloomberg that a Chinese vaccine on trial in Brazil has been stopped. The trial has been stopped because of adverse effects. So I think we're going to be seeing a lot of volatility from that news flow as well.
Yeah, I mean, there's all sorts of vaccines whipping around right now, but the big one is really the U.S. That's really what the markets are continuing to focus on. Of course, we have to be concerned about adverse effects that are ultimately going to happen. But the thing is that we've seen adverse effects, but the effects haven't been adverse enough to stop the trials. And this is the thing. The FDA is pretty strict with their guidelines when it comes to safety and health. And if they've moved through the third trial on a number of these, or at least on the main Pfizer vaccine, this is huge.
Yes, absolutely.
Can't ignore. I mean, this is really a game-changing panacea, really, for people getting back out. But we still have to concern ourselves with how do we bridge the global markets and the global economies to when the vaccine gets delivered. That's the biggest thing. Guess what? We default back to the U.S. stimulus debate again, and that continues to weigh on market sentiment. If there's ever time for a stimulus to come in, it would be right now, because this is when it's really needed. We need that, something to bridge the gap. Just not there right now, but I'm hoping lawmakers can see the light of day here, that throwing stimulus behind a market that's starting to reopen on a vaccine impulse could be quite positive. So fingers crossed we'll get something resolved in the near.
And Steve, actually, that was my next question I was going to ask you, which is basically the dust is being settled in the US with the elections and stuff. Stimulus is something that you've brought up that I think could really give put wind in the sails. But where do you see the risks in the markets for the rest of the year?
Well, that's a very good question. I think it's just the lingering economic risks that we're going to face. The market's going to pivot to those risks, which are clear and present dangers to the recovery. And this is why central bank policy and fiscal policy is so important. A very limited room that the central banks can do. We've seen them trying to affect more QE. It looks like they're at the end of the runway. Mostly that QE is just really buying what the governments are putting into the markets right now, basically just to monetize all the government debts. It's not really getting through to the economy to any great degree. It's sort of a central banker of the governments, really. That's
yes. And the thing is, this is again the argument about the divorce of and the relationship between Main Street and Wall Street. So Main Street is still hurting, Wall Street is not.
Yeah, I mean, it's a stimulus-driven rally. I mean, there's no two ways about it. If the Feds didn't come in when they did back in March, we wouldn't be here. And this is why the market continues to really depend on what the Federal Reserve Board does. Still the biggest policy bank in the world, and how they really move forward will dictate the pace of this recovery in markets. I think the markets are going to continue to rise. I don't think this is a time when you should start to be considering fading the market move. I think it's a time not to go all in, but to start looking at opportunities. I mean, I'm not suggesting you have to go all in and buy the S&P. There's other sectors around the world right now. If you're looking at financials, the SGX could stand a good place to look at. If you're looking for commodity prices to rise, the ASX in Australia looks good. If you want to play the cyclical trade, well, there's no better place than Europe. So it's a heavy-weighted cyclical play. You don't have to keep all your money in the U.S. There's potential to move out of the U.S. markets, and I think we're going to see that rotation manifest because of this, especially to emerging markets. I think some of the bigger trades here are going to be around emerging markets. Look at India, for instance. It's just been ravaged by COVID. I think once the vaccine starts to get distributed in the next year or so, 6 months to a year, I'm just guessing, things will really kick up there. And this is something that the markets can continue to invest in now, because of the policy impulses by global central banks around the world can paper over all the intern cracks and provide that bridge so investors can start looking at assets in emerging markets around the world. The one hiccup I have, and the one caveat I have, is really all predicated on interest rate volatility in the US. Right now, bond markets yields went high last night, but it was calm. It wasn't an overreaction. It was a good, decent sell-off, but it wasn't a complete meltdown. Markets took it well in stride, but this is a big thing. Provided interest rate volatility, especially in the U.S. bond markets, remains low, I think emerging markets will continue to flourish.
Thank you for your insight, Steve. We've been speaking to Stephen Innes, Chief Global Market Strategist at AxiCorp on BizTech's Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.